Well, I would like to thank Peter Easton and the conference organizer for the opportunity to present. My name is George Ruch. I am an assistant professor at the University of Denver. The paper I am presenting today is co-authored with Peter, as well as Gary Taylor at the University of Alabama, and is titled Accounting is the Language of Sustainability, a Measurement Framework for Carbon Accounting. It will be published later this year in Accounting and Business Research. So to give a brief overview of the paper, we broadly explore the prospect of adapting financial accounting concepts to sustainability accounting. As an illustration of this potential, we propose a framework for accounting for net zero pledges by adapting principles of lease accounting. There has been a recent trend in companies pledging to achieve net zero carbon emissions by some specific date in the future. So using principles and mechanics of lease accounting, our proposal provides a framework for companies to not only pledge net zero carbon emissions by a specific date, but to quantify their path to net zero carbon emissions and to measure and report their progress along that path. So to show how we adapt lease accounting to accounting for net zero pledges, I'll first give a quick summary of lease accounting. At the inception of a lease, the lessee recognizes a right-of-use asset representing the right to use the leased asset and a liability which represents the obligation to make payment. This lease asset and liability are measured at the present value of the future lease payment. Subsequently, as we move through the lease term, the right-of-use asset and lease liability are amortized as the lessee uses the leased asset and makes lease payment. Additionally, the lessee recognizes lease expense, which is equal to the sum of the interest expense on the lease liability and the amortization of the right-of-use asset. So as a base example, let's consider an operating lease in which the lessee is required to make 4 annual payments of $100. If we assume a discount rate of 10%, the present value of the lease payments is approximately $317. So at the inception of the lease, the lessee records a right-of-use asset and a lease liability equal to $317. The lease asset and liability are amortized using an effective interest approach. The total lease expense each year is $100 equal to the lease payment amount and can be expressed as the sum of the interest on the lease liability and the amortization of the right-of-use asset. So now let's adapt this to net zero pledges. When a company makes a pledge, or in other words, at the inception of the pledge, it recognizes a pledge asset and a pledge liability equal to the present value of the pledge emissions. The pledge asset represents the company's implicit right from society to emit carbon at the pledge levels, and the pledge liability represents its obligation to limit carbon emissions to the pledge level. Instead of monetary units, the pledge is measured in tons of CO2 equivalent. Subsequently, as we move through the pledge, the company generates emissions. It will amortize the pledge asset and liability using an effective interest approach, just like we did in the lease accounting example, and it will recognize actual emissions, which will be the sum of the pledged emissions and any variance from the pledge. So to begin and show the translatability here, let's just take an almost absurdly simple example to illustrate how we can translate lease accounting to net zero pledges. So the company issues a pledge, in this case, to achieve net zero carbon emissions after 4 years. However, during the 4 years leading up to the pledge target date, the company continues to emit 100 tons of CO2. This further simplifies, to further simplify the example, let's suppose that, again, the company is just going to do what it says it's going to do, and pledged emissions will equal actual emissions. All right, so as we go through, I will layer on complexities to try to make this more like a more realistic net zero pledge example. So now, one challenge here is that to adapt lease accounting principles to this setting, well, we need a discount rate that represents a time value of carbon emissions. The idea behind a time value of carbon is that curtailing emissions sooner rather than later is less harmful to the planet. Or said another way, a ton of CO2 today is more harmful than a ton of CO2 tomorrow. So we discussed possibilities for estimating this discount rate for carbon emissions in the paper, but for the purpose of just showing the adaptability and the illustrations in this short presentation, we're just going to go ahead and assume the same 10% discount rate for the net zero pledge example. So using this 10% discount rate, the pledge asset and liability are measured at a present value of 317 tons of CO2. The pledge asset and liability are subsequently amortized as the company generates emissions over years 1 through 4 with a specified discount rate. With this specified discount rate, we can then use the same effective interest approach we use in accounting for leases. Note that emissions equal the sum of interest accrued on the pledge liability and amortization of the pledge asset, just as we saw in the lease accounting example with the right of use asset and the lease liability. So now, to give maybe a more realistic example, let's add one extra layer of complexity here and assume that the company sort of gradually approaches net zero. It doesn't just get there all at once. So what we're going to look at here is we're going to assume the company reduces emissions by 25 tons of CO2 each year to achieve net zero by year 5. Now, again, we're still going to use the simplifying assumption that pledged emissions equal actual emissions. So if we assume the same 10% discount rate, this pledge receives a present value of 208 tons of CO2. So note that the present value of this pledge is lower than that of the pledge in the previous example. This indicates that this net zero pledge, in which the company gradually curtails emissions, is less harmful to the planet than the pledge in which the company does not curtail emissions and gets there all at once. So using the same effective interest approach, the pledge asset and liability are, of course, amortized as the company generates emissions. So next, let's address the assumption that pledge emissions equal actual emissions. A pledge is, of course, just a pledge. It's not some contractually fixed amount like a lease payment, but rather an estimate that is subject to change. Additionally, the accountability mechanisms for failing to adhere to a net zero pledge are less clear than the accountability mechanisms for failing to abide by the terms of a lease. So therefore, our framework must allow for the prospect that actual emissions do not equal pledged emissions. So let's suppose we have our pledge in which we curtail emissions by 25 tons of CO2 each year, but actual emissions deviate from those pledged amounts as shown here. We can split actual emissions into pledged emissions and a variance from pledged emissions. This allows us to recognize actual emissions and still amortize the pledge asset and liability using our effective interest approach. Additionally, by breaking emissions into pledged emissions and variance from pledged emissions, we provide an accountability metric that allows users to assess a company's progress against what it pledged to do. So turning to the amortization schedule, we see an additional column. We add an additional column for variance from the pledged emission. The effective interest amortization is done on the basis of the pledged amount, but the emissions reported each period include variance from the pledged emissions as well. All right, as a final example, what if things change and the company decides it needs to revise its pledge? Perhaps its estimates of the extent to which it is able to curtail emissions do not match reality, or it's overly optimistic in how soon it can get to net zero. Regardless of the reason, our framework allows for revisions of these net zero pledges. So to illustrate, suppose after year 1, the company revises its pledge so that it achieves net zero carbon emissions in year 6 instead of year 5, and curtails emissions a little slower at 20 tons of CO2 rather than 25 tons of CO2 per year. So in the year of the revision, the company would account for the change in the revision prospectively and record an adjustment to get the present value at the end of the year to where it should be under the revised pledge. So here we have an additional adjustment column on the amortization schedule to facilitate adjustment. In this case, the adjustment of 72 is what is needed to get the present value at the end of year 1 from that under the original pledge to that under the revised pledge. Subsequently, the company will then continue with its effective interest approach under the new pledge estimate. So to conclude, our proposed framework allows companies making net zero pledges to measure and report their efforts towards achieving net zero carbon emissions. I just want to thank you again for the opportunity to present and to share with you our ideas.